Be Wealthy and Smart, episode 1034.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about how the sentiment is so bearish, it's bullish. That was something I tweeted to my VIP group, and they said that was a tweetable quote. So I'm making it the title of this podcast because overall, that's really what I'm seeing right now is the bearishness is off the charts. But we'll talk about that in a minute. First of all, this has been the worst start to the year for the stock market since 1980. Stocks are down double digits, and it's been one of the strangest times investing that I can remember. And I've been through a lot. We went from the best day of the year to the worst day of the year in 17 and a half hours. That's right. Markets were up sharply. Then after the interest rate increase, they were down sharply, all in the space of 17 and a half hours. Now, while I wasn't calling for the Fed to actually raise interest rates, they did tighten by 50 basis points, as they had been talking about. But I really thought that in light of the weakening economy and the negative GDP print, that they would think about that a little bit more and perhaps err on the side of cautiousness. But I think there's so much pressure because they are so far behind the eight ball that they really felt that interest rates are so out of whack with the rate of inflation that they felt compelled to make a 50 basis point increase. The market took it very well that day, but it sold on the news, and it really sold off hard. In anticipation of the Fed raising interest rates, they had already moved up, which had already started to slow down the housing market some. We're hearing about people not refinancing and mortgage loan officers getting laid off. We're hearing about sales slowing down, although we are still hearing that many sales are getting multiple bids, still low supply in the housing market. So it still is strong, even if it is slowing a bit. I hope you did take my advice and refinanced last summer and earlier this year, when I really encouraged you to take advantage of those low interest rates. So things are still strong in the housing market, and the consumer makes up 70% of the economy. And that's what's really important, is the consumer is still doing really well. The labor market is still really strong. People have jobs. They have discretionary income to spend. That's all very positive. Now, when we look at what happened with the stock market, because interest rates were moving higher, the money managers started to go defensive. So they rotated into more defensive stocks, and that left the growth stocks on sale. The growth stocks are actually selling at a discount to the value stocks, and they're still going to grow at double-digit rates. Many of these tech stocks are doing really well, but they're so cheap they may get rebalanced into the value index. That means that growth stocks, specifically tech stocks, are a great buy right now. And the labor shortage requires tech spending, because if you don't have people to fill the positions, you're going to use AI to do some of the repetitive tasks, and you're going to spend on technology to do that. We also have some technology stocks that have special situations and catalysts, like Tesla, Amazon, and Google, that we know are going to be splitting. And while that doesn't change anything, technically, it does change psychologically because people tend to want to own the stocks before they split, so they have more shares in their portfolio. So I think that's going to drive more capital toward Tesla, Amazon, and Google, and that makes them a great buy, just like I've been saying. Now, I also think that because we've had so much stimulus and 40% of the money out there has come from stimulus in the last few years, that nobody's talking about a potential crack-up boom, which is what stock markets do. They boom on the upside after a lot of stimulus. That's typically what happens. We've seen this in other countries that have had a lot of stimulus, that it ends up that their stock markets do really well. That's one reason I think the market is going to turn around. Another is I think there's too many hedge funds and other investors that are short, meaning they're going to have to buy stocks to cover their short positions. And I've been saying I think we're going to have that crash on the upside where lots of shorts are going to have to buy and will be chasing stocks to cover their short positions. Another reason why I think the stock market will go up is because of cycles. If you've read my books, you know I'm a fan of cycles. And for some reason, these experts that are talking about cycles are missing the most obvious cycle of all. That is the cycle that was the 1920 pandemic cycle that I talked about in my book. You see, every 100 years, we've had a pandemic. Here's what I wrote on page 194. Even with COVID-19, we are seeing a 100-year repeating cycle. Did you know that there has been a pandemic about every 100 years? In 1720, the Great Plague of Marseille. In 1820, the cholera pandemic in Asia. In 1920, the Spanish flu. And in 2020, the coronavirus. Using that cycle, I was able to tell my VIP experience members we would be dealing with COVID-19 for 3 years, the same length of time that past pandemics lasted, a forecast that shocked them at first, but is looking on point. And that's exactly right. 2020, 2021, here we are in 2022, the third year. Now, the other thing I wrote about in regard to cycles is on page 198. There is also a cycle for every year in a decade. For example, the second year of a decade, a year ending in 2, is often the low. Some interesting cycles are coming up in 2022. It will be 20 years since the 2002 stock market low, 40 years since the 1982 low, 60 years since the 1962 low, 80 years from the 1942 low, and 90 years since the 1932 low. Do you see how every year with a number 2 in it has been the low of the decade? Now, when we go back to 1920 and we look at that decade, the low that decade was in 1921. But from that low point, when they had the Spanish flu, from there till the high point of the decade, which was, of course, 1929, do you know how much the stock market went up during that time? It went up 500%. 500%. So if the low of the decade is in the year that ends with 2, we could be seeing the lows for the decade right now. We also could be seeing a repeat of the 1920s decade when stocks go up 500% between now and 2029. I can't make any promises, but cycles do have an interesting way of repeating. And with all the money stimulus we've had, the massive short positions, and the massive bearishness right now, well, I think we're setting up for a massive rally. And I'm calling for a massive rally to start sometime here soon. And it may be right around May 20th. The moving average convergence divergence indicator looks like it's bottoming to me and turning, and markets are oversold. So everything tells me we are at or near a bottom. In addition, one of my favorite indicators of bearishness and bullishness is the survey done by the American Association of Individual Investors. And right now, it's the second most bearish time that it's been in the last year. The most bearish time was the week of April 27th. This is the second most bearish time, the week of May 4th. Bearishness is at 52.9%. Now, historically, that is a very high percentage of bears, which, being a contrarian and looking at this as a contrarian indicator, tells me this is very bullish. Now, when we look at cryptocurrencies are moving lower, very much correlated to the NASDAQ right now. Bitcoin is still very dominant, but is having some issues. But we are in the early days of cryptocurrency. In fact, this is back when the internet was coming out. The very early internet days, we had dial-up internet. It was very slow and cumbersome, and nobody saw that the internet was going to be so important in our lives on an everyday basis for everything that we use. It was hard to imagine back then. I'm sure some people foresaw it, but really when it was slow and cumbersome and brand new, not many people were really seeing the full impact that the internet could have in our life. The first thoughts about how the internet was going to impact us was really more like putting billboards up. They were websites that just had words on it that we could read. It wasn't even functional. So the internet changed a lot. Its functionality changed a lot. We got eventually to be able to conduct commerce on websites. This was not all possible at the beginning when we had dial-up internet. And I'm telling you this because there are parallels to where we are with cryptocurrency. In the future, I think we're going to be using cryptocurrency for a lot of things. We're going to be sending money around the world very easily to anybody, anywhere, almost instantaneously. We're going to be able to tip people with our cryptocurrency. We're going to be able to stake cryptocurrency and earn passive income and operate as our own bank or as our own insurance company, as our own real estate company. There's going to be so many uses for cryptocurrency that we aren't even seeing as possible right now because we're in the early days, almost like dial-up internet. But one big milestone recently happened that caught my attention because this is major, and that is Colorado became the first state to approve cryptocurrencies as payment of taxes. Do you know why that is a huge milestone? Not just because it's the first state to accept cryptocurrency for taxes, but when you accept something for taxes, that is how you define money. That is essentially saying cryptocurrency is money, and that is a huge change. And Colorado did not just mention Bitcoin, it mentioned cryptocurrencies as payment for taxes. So that's huge. We also see that the dollar has been strong. It's been the strongest right now that it's been in the last few years. And that's been causing a bit of a problem with multinational companies because that cuts back on some of their profits when the dollar's strong. When the dollar weakens, it gives them an advantage. And it also allows foreign money to come into our markets. So as the dollar's peaking here, I think we're going to see it sell off, and that's going to drive more money back into our markets. It's going to make certain companies more profitable. And that, I think, will be a catalyst to make stocks bottom and turn upward. Also, I think the supply shortages are getting worked through. We're also seeing inflation having some early signs of letting up, so that we're not continuing to see increasing inflation. We're starting to see it level to start decreasing a bit. I do think inflation's going to work its way through in the next few months, and that's going to be positive for stocks as well. So everything is telling me the surprise is going to be on the upside. We have so many things that are positives that can happen. And in addition, we got news yesterday that oil prices were coming down a bit, and that the United States was sending a number of diplomats back to its embassy in Kyiv to coincide with Victory Day, according to CBS News. So I think behind the scenes we have diplomatic relations going on, and I think any kind of peace with Ukraine and Russia is going to be completely unexpected and could lead to a much higher stock market. As I've described, there's lots of positive catalysts that can be happening that are going to send markets higher. And I truly believe we just have to stay through this, because markets can turn on a dime and have these sharp rebounds that you don't want to be out of the market and miss. You have to stay invested in order to get those sharp rebounds. Just like we had in that 17.5-hour period where we had a sharp move up, you have to be in. It can just turn on a dime like that without people really seeing it broadcast ahead of time. So hang in there, stay invested. Upgrade to quality. Look if you can move into more quality situations, more quality growth stocks. Buy the dip if you have cash to put to work as you can be dollar cost averaging into these declines. I don't have an exact date that I think the market will turn, but I don't think it's far from here. And all of that money that has been created in the last few years, I believe is ready to find its way back into the stock market in a major, major move up. Things are so darn bearish, it's bullish. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.